All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer 4 great listener questions. We got all of these from various sources. If you have a question, you can reach out to us at these various sources, i.e., newsletter at einvestingforbeginners.com, or you can reach out to us on the Spotify app. You can ask questions on there, or you can send us questions via the old standby, the social media stuff. So either X or LinkedIn. So with that, let's go ahead and dive into these interesting questions. So first one, if you are looking to thin the herd of stocks in your portfolio, is now a bad time to sell? The idea would be that it really doesn't matter if you sell during a downturn as long as you are buying during a downturn, or does this math not math? So this is a great question from our Value Spotlight community. So Andrew, first take, Betty.
Yeah, great question. To me, the math does math. If you sell something low, but you buy something low, that can be a pretty good trade. So I think the math is. What do you think?
Yeah, I think it maths. It definitely, to me, it maths. I guess if the idea is to thin the herd, would you maybe sell out of a few things to buy the one thing? So in other words, if you're looking at semiconductors, would you get out of Intel? Yes. And buy other things that you want to buy? Like, do you follow my drift? Am I making sense? Like, what are your thoughts on that?
I would say I'm trying to thin the herd every time. Like, I can get pretty harsh with it. It's strictly, this investment should be working for me. Obviously, you give investments time to kind of play out. If a business struggles, okay, we're not going to give it too much grief for stumbling. But if a business stumbles and stumbles and stumbles, that might be a sign to get out. And that's something I did recently, not related to the market volatility. A company I owned took a big loss on one of their contracts. And so I was like, okay, that's probably a one and done loss. It was not a small amount. It was like 1.5 billion. So we're talking about a pretty big loss. And then in the most recent quarter, they took another one. And so it's like, all right, if you're a company that's growing, that's one thing, maybe you overextend. But a company doesn't grow too much already is kind of on that watch list of selling watch list. I don't know. We should come up with a phrase for that. But if you're already on that because you're like a slower grower, you're not growing as much as something else, and then you're also having cost issues and now it's leading to losses in the company, then yeah, if it's a repeat offense, I think the more of those you get, the easier it is to sell, and probably the better it is to sell, unless there's some crazy outlier thing that's going on that's going to save the business. That's probably what I would do. As far as thinning the herd during a volatile season, I think that can be good if something just jumps out at you. We just recorded an episode on this, so go back and listen to it if you haven't already. I talked about why I bought Adobe. So if it's a best-in-class business, it's cheap, it's very rarely this cheap, then yeah, maybe you want to thin the herd. But I've had to learn the hard way that it's really easy to get excited about a new opportunity. And the more selling you have to do, you've just exponentially increased your chances that you got a decision wrong. So if I sell something to buy something else, that's not a chance for one bad decision. That's a chance for 2 bad decisions. Because I could be selling something that's going to go straight up right when I sell it, which seems to happen way too often. And then I could be buying something that just continues to go down or has some other red flag issue that I'm not aware of. If you're talking about selling 2, 3, 4 things at a time, I've never been very good at picking the right 4 to do that at the right time. And so, ideally, whatever stocks you are thinning, these have been on your sell watch list for a while. I have the luxury of talking to Dave every week, so we have these stocks that show up on this watch list.
Naughty list.
Yeah, there you go. We both, okay, cool. Yeah, I like that. Naughty list. Stocks on the naughty list. So if they've been there a while and you have multiple offenders and then a great opportunity comes by, sweet. Thinning the herd there maybe was a great idea. But if you're thinning the herd to thin the herd and you've just increased the number of decisions you have to make, there's a decent chance you're going to make one of those wrong. and maybe you would have been better off not to do that.
Mhm.
That's kind of how I think of all that.
Yeah, I think that's a really smart way to think about it, because the surface area of making more decisions leads to more opportunities to be wrong, right? Or to make a mistake or to do something emotional as opposed to more thoughtful and rational. I think it's just like trying to buy 3 or 4 things at the same time can be a challenge. I would think that selling 3 or 4 things at the same time would be equally as challenging. Of course, circumstances are going to differ. Maybe these are the first 4 things you ever bought, and you really bought them emotionally, or you didn't feel like you really knew them. You didn't know them, and so you just pulled the trigger because you wanted to buy something. And now, in hindsight, you're like, yeah, okay, those were poor decisions for whatever reasons. I think that can be legitimate, but the flip side of that is if you're trying to thin the herd and try to find something ultimately better than all 4 of those, then that's also something to consider as well. If you're trying to get a 20% return on one stock and the other 4 are earning 30% combined, well, then maybe the math doesn't math. So that could be something to also consider. I mean, it's not easy to do all this. I guess, what are your thoughts on the idea of maybe selling things to go to cash and sitting on cash as the volatility goes along? I know there are people out there that do that, and I'm not casting judgment, yay or nay. I'm just curious, like, what your take is, like how you would think about that. I prefer to be in the market. That's just the way I like to do it. But what are your thoughts on that?
Yeah, that's how I like to do it too. I've got decades until I need this money, ideally. So being in that accumulation phase, it's like, okay, I understand the market should rebound at a certain point. I had mentioned the bear market journal I had written. This was after 2020 bear market. And I was like, okay, I'm in a clean headspace now. We've moved past this bear market and the market has kind of come back and it looks more normal-ish. And so I remember writing my thoughts about it. One of the things I said was the best thing I did, I made a lot of mistakes of omission. Like there were a lot of businesses I could have bought. Well, we're not going to talk about that. But the best thing I did do was I had a bunch of stocks that they crashed really bad. And that's a really, if you've never been there before, it's a emotion that it's very hard to prepare for. Like when you look at a stock and you've held it for 4 years, and today, because it has crashed in the last couple months, you're at a 0%, or you've lost money after 4 years, that feels like it was a big waste of time. And that can drain you emotionally. And I imagine the more money you have, the worse that is. But the best thing I did during that time was kind of just block out the fact that a lot of my stocks were in that category. And so it wasn't even anything I bought necessarily that helped my portfolio rebound after the bear market. It was just the fact that I just let everything recover. I didn't touch it. I just stayed fully invested. And I did a screenshot in the blog post of like a before and after. And it was only 12 months. And the result, the difference was just staggering. You went from that gut feeling in your gut of like, oh man, I feel like I wasted time with, look at most of my portfolios this way, to like, oh my goodness, this portfolio has made a bunch of money and this stock has done great, that stock's done great. So it's amazing how 12 months after a bear market can really change a portfolio. And you'll really just see that, at least in the 2020 bear market, it was across the board and there's no getting away from it. And the only way to recover was just to hang on. So that was one of the things. I think it's Kane Brown has a song that says, I did one thing right. If I did one thing right in 2020, it was not to sell and just stay fully invested.
I think that's a great lesson to share with people.
Yeah. Well, I'm glad I wrote it down at the time because it was like, I've forgotten by now. And it's only because I like reread it, to kind of refresh myself. It's amazing what we'll forget.
Oh, yes, it is. Yeah. I will say this again for the umpteenth millionth time. Having a journal about our investing journey is one of the best things you can do, whether it's cataloging why you buy things or why you sell things, or just to your point, the different emotions that you're going through. We think we are going to remember all this stuff. We don't. And I don't know about you, but it can be jarring to read some of the things you wrote or what you were thinking 2-3 years ago and think, oh my goodness, I don't even remember thinking that. Did I think that? Holy wow.
Yeah.
Okay. All right. So
Yeah.
it can be very illuminating.
Yeah. Maybe we can dive into your teenage journal after this, or
God.
diary.
No, we don't want to do that. That's full of depressing things. We don't want to go there. All right, let's move on to the next question. So this is in relation to a blog post that I had written about DCFs, or discounted cash flows. So Ton says, you state that DCF is related to inflation. I think a DCF is also valuable if there is no inflation. If you have $100 of the future today, I can invest it and make a return on the investment. That also makes a dollar today more valuable than the dollar in the future. Hence, that dollar in the future has to be discounted also if there's no inflation. So what do we think of this? So great question, and I know how I answered it to Ton. I would like to hear your take.
I say he's spot on. What do you say?
Yeah, I said he was spot on too.
Yeah.
Do we want to explain why we think that this question is spot on?
Yeah. So if you're trying to explain a DCF to a beginner for the very first time, trying to keep it very simple, which is hard to do for a course that people pay thousands of dollars in business school to learn. But DCF, who, what, where, why, when, like what are we trying to achieve there? And then how does inflation play into that?
Inflation, basically, the way it works when we're thinking about DCFs is inflation causes the buying power of our dollar to be less in the future than it is today. And so in the future, whether it's a day or whether it's 10 years, that your buying power in theory is less valuable than it is today. And so when you're doing a discounted cash flow model, you have to look at that theory and project that the cash flows that Microsoft generates today are going to be less valuable in buying power in 10 years. And you have to discount those to an appropriate discount rate. And that could be a whole other conversation. And then you add them all back, and that's how you figure out what your value today of that dollar is for the buying power of Microsoft. And so that's in essence what a DCF does.
Yes. And I think a good way to visualize that, at least for me, is that Microsoft, to use your example, could grow their cash flows, but if they don't grow fast enough to account for inflation, then even though, Microsoft has more cash, if that cash has less buying power in 10 years, you want the DCF to be able to expose that. And that's kind of what it does. It in theory, if all the pieces were working correctly, you would see, okay, Microsoft grew less than purchasing power, so actually the value went down.
Right.
That's what DCF should do. At the end of the day, if we want to have existential crisis, DCF is kind of like, if we think about the economy, we're all just bartering something, right? We're bartering our time for this fake piece of paper that allows us to buy goods and services. When you're deciding, do I pay $30 for a haircut or $15 for a cheeseburger, that value judgment is really just trade-offs. You're thinking, do I want to spend, when I choose that cheeseburger is worth $15, I'm choosing that I will accept 2 cheeseburgers for the price of a haircut, basically. And that's what the DCF's doing too. So you can make that comparison with or without inflation. I just made a comparison of 2 cheeseburgers and a haircut without taking into account inflation. The DCF gets complex when you go over, okay, do I want 2 cheeseburgers now, or do I want 4 haircuts in 5 years? Like that's what you start getting into when you dive into the numbers, but that's really all it is. And so, I think Tan's spot on. I think he understands the concept that we're just trying to consider trade-offs, and that's all a DCF is. And so when you buy a stock, you ask yourself, okay, the stock went up in 10 years. Is that a good value for me? Well, it depends on what else you could have bought. If you would have just put it in a savings account, or if you just bought some bonds, What kind of return could you have made from doing that over 10 years? And so that's what the DCF helps you do. But it definitely is wrapped around a lot of, there's been plenty of Excel spreadsheets out in the ether that have done many, many calculations to try to figure out the perfect DCF. But at the end of the day, I think that's really what it's doing.
Yes. I think in the trick, that's a great explanation. I think the trick when you're trying to value a company and using a tool like the DCF is you have to understand the theory and what you're trying to get behind. And I think too many people can get so wrapped up in the calculations themselves that they aren't seeing the forest for the trees. What's really important is understanding the economics of the business, how they're doing what they do, and understanding what could happen in the future and how you can take advantage of that today by buying it for less than it could be worth in the future. And that's really what a DCF boils down to, is it's a tool you can use, and you can make it as complicated as you want. But as Professor Oswald Damodaran, one of my valuation heroes, always likes to say in his lectures, the less inputs, the better. We were just talking about making, too many decisions, buying or selling stocks. Same applies when you're trying to use something like a DCF. The more inputs you put in, the more margin for error there is, because we will make mistakes. And a DCF, although it may look scientific, it is not. And it is full of biases and projections and estimates. And really the only thing you know for sure is the share price that starts today and how many shares are outstanding. Everything else is basically a projection. I love them. I'm a big fan of them. I love for people to use them, but I also think people need to understand that it's not the end all be all. It's not the peanut butter of finance, and it has its limitations, and you have to be aware of them. And Ton makes a great point, and I think if you don't understand the impact of inflation, and if the company can't invest faster than inflation, then what are you buying it for?
Yeah. Well, how many DCFs have you seen that the free cash flow actually goes higher? Like, have you ever seen a DCF where the free cash flow doesn't go higher? Right?
No.
But like, that's obviously not true. There's plenty of businesses that don't go up.
Yes. Plenty.
So to your point, it's more like peanut butter without sugar.
Right.
Like straight from a peanut, not processed.
Right.
Like,
Yeah.
that's the kind of peanut
a ground peanut and some stuff added to it. Yeah.
Yeah. It needs some jelly.
Yeah. It definitely needs some jelly. Strawberry or grape? Important question.
Yes.
All right. So let's move on to the next question. So this is sort of free cash flow related. So his name is William, and he has a question which causes him a lot of confusion. So he's asking, why, when we calculate net working capital, do we use cash flow as its source and not traditional balance sheet metrics like current assets minus current liabilities, which is also known as the current ratio? He never understands this. So I guess, do you want to try to help explain that to him, why we would choose? I guess before we do that, let's talk about what net working capital is. And maybe then we can explain. That would probably be a better use of explanation. So,
for sure. So let's visualize the financial statements if we can. I know it's kind of difficult, but we'll try to do it somewhat decently. So if the top of a balance sheet has your assets and the bottom of a balance sheet has your liabilities, split in between your assets section, your liabilities section is current assets and current liabilities. These are things that are not long-term. They are short-term, sometime in the next 12 months kind of thing. So the type of short-term assets you can think of would be cash. If I want cash, I can take it out tomorrow. It's a short-term asset. Longer-term assets would be like a factory or an office building or a piece of land. Those things, you might not be able to get the cash out in the next 12 months, depending. So those are not considered short-term. Working capital is simply the current assets, so that top half of the assets, and current liabilities, that bottom half of the liabilities. Because we're talking about short-term in the next 12 months, It is the short-term needs of the business. It is like what would you say?
Like the engine that runs it's like, yeah, it's like the engine that runs the car. You can't
Yeah.
you can't get, the car won't go anywhere if the engine doesn't run.
Yeah, exactly. It's the day-to-day, the things that are needed day-to-day for a business to survive. So they need cash to be able to pay employees. They need to take invoices from customers, things like that. So the way I like to think of it is every business is a little bit different. We've established that, but I like to think like retailers are pretty easy to understand, or even easier. A shoe company like a Nike, they have to grow using inventory. So they have to buy a bunch of shoes, and then they put their little Nike logo on it, and then they sell the shoes, right? Or they manufacture the shoes and then they sell them. So that goes as inventory. That's part of working capital. And I like to think of working capital like that. Short-term needs, things like inventory, things like accounts payable, accounts receivable, those transactions between the businesses to keep the cash flowing around. Those things all make up working capital. And that's how I think of it. So what's the next piece of that?
The next piece of that is, how does that definition of net working capital, how does that correlate with what goes on in the cash flow statement, and how does that impact us calculating something like cash flow?
Mm-hmm. Yep. Do you want to take that?
Sure. All right. So the way you think about it is the net working capital that you see on the balance sheet also connects to the cash flow statement. And the cash flow statement, if you look at it, it breaks into three different sections. You have operating cash flow, you have financing, and then you have investing cash flows. The operating cash flows are the ones that we're focused on, not only for our discussion now, but if you're looking at trying to calculate cash flow or free cash flow for a business, you have to look at that top part of the cash flow statement. The way that these two statements connect, the balance sheet and the cash flow statement, you have to think about them in relation to how they work. So first of all, when we see these two statements in the financial statements of the business, we'll use Microsoft because that's easy. Microsoft's balance sheet is a snapshot of one day in time of the business. So what you see on the balance sheet in Microsoft's 10K, for example, is a snapshot of today, which is Thursday, May 1st. So everything that's happening on May 1st for Microsoft is in that balance sheet today. The cash flow statement it's accrual. So all the money that happens in the cash flow statement happens over the course of the quarter, and then they tally everything, changes of money going in and out of that account. And then that's what they relate on the cash flow statement. So it can be a little confusing because if you look at something like, we're talking about current assets, so something like inventory. Inventory is a part of current assets on the balance sheet. There is a change in inventory on Microsoft's cash flow statement. Those numbers don't match up. You would think, okay, if there's a change between one quarter and the next quarter, that difference should equal the changes on the cash flow statement. Unfortunately, they do not, because we don't see all the things that happen behind the scenes, and the way that they write the statements and the timing of everything, it's not going to be apples to apples. When we look at the cash flow statement, we're trying to figure out how much money went in and out of the cash account of Microsoft, and we look at the change of those numbers for the net working capital. So basically what we're doing is we're taking all those line items that are underneath that section in the cash flow statement, changes in inventory, changes in account receivable, changes in accounts payable, things of that nature, and we basically just add them up. And you look at that change, and that's how we determine how much money went in and out of the current assets and current liabilities on the balance sheet. And then we use that number to help us calculate how much money did the company use to pay for the engine to run for that month. And that's how we try to calculate that number. It can be confusing because oftentimes that number is actually negative. And so you would think that means that, hey, they spent more money than they brought in, but it's actually the other way around. And so if the number is negative, that means that there's more money coming in than going out. It's a little confusing and it's off. It doesn't make sense that way, but that's why you add those numbers up on the cash flow statement just to see what kind of money is going in and out. And that's how we use that because the cash flow statement is basically the cash of the business. It's like our checking account.
I work really hard to find the best insights I can every single month at Value Spotlight. To see a sample of my previous work, go to stockwriteup.com. Yeah. I remember this being something that hurt my brain for like 2 years straight.
Yeah, me too.
And I remember Jay June from Old School Value wrote a blog post about it. And I would read his blog post and I'd be like, I got it. And then I'd walk away from the computer and be like, I forgot it.
Yeah, I don't got it.
Like I said, I didn't understand for 2 years. And I think I understand now. The reason that an investor would want to calculate free cash flow is to try to figure out, at least the way I understand it, try to figure out how much free cash flow is available for shareholders. You have the cash that, gets flushed around inside the business to run the business, and all of those expenses are kind of in one box. And then once you've kind of taken all of that out, you have free cash flow. And then free cash flow can be used either to return it to shareholders or to reinvest back into the business, into growth, into a lot of the other creative things that businesses can do with cash. So some businesses, they actually get cash from their working capital, which kind of doesn't really make sense. But if you think famous examples of this are like Starbucks. I've seen lots of videos on YouTube about how Starbucks is like a mini bank. And it's because people will pay Starbucks money for gift cards, and then they either, which I've done, I've sent it to my mom and I was like, did you get my gift card? She's like, what? I sent it to your email. Come on. Like, people will pay for gift cards and then either lose the gift card or not buy a coffee with it for 3 months, 6 months, 12 months, whatever. That's all cash that's going to Starbucks early that they can use to do whatever with. And you can think of it as free cash flow for shareholders. On the flip side, if we take a shoe business like a Nike, let's say that they have to buy, I don't know, reams and reams of rubber to make their shoes. That's money that has to go out before they can even make the sale. That's money that needs to be subtracted from working capital. So in that case, working capital is an investment they have to make and not a source of free cash flow. And so I don't know if that even I don't even know if that relates with like what you were talking about between like the minus and the positive. But that's the way I try to think of it, is like, okay, rather than try to think minus or positive because that hurts my brain, is this a source of capital for the business, or is it something they need to fund for growth? So source of capital, Starbucks, gift cards. Something you have to fund in order to grow, inventory, Nike, inventory. And that's the way, when I think of working capital in that way, it helps me understand at least if the free cash flow is moving in the right direction or not. And I think that's more important if you're trying to figure out working capital for a DCF.
Yep, I agree. I think that's a really good visualization to help. To me, it makes more sense to do it that way, to visualize the shoes on that Walmart has to buy, the Nike shoes that Walmart has to buy to sell. That's an investment and it's money sitting on their shelf. Whereas if they are paying employees, that's money going out that they have to use to pay those employees. I mean, they're both money going out, but it's just how you have to think about how that impacts the capital of the business.
Yeah. Let's say they have a quarter where they don't really buy many Nike shoes. So they just had a bunch of Nike shoes on the floor and then they sold it through and got the cash for it. Well, then in that case, working capital goes up because you didn't have to give away that many, or you didn't have to pay for as many shoes. Your working capital went up. But then if you have a quarter where you bought too many Nike shoes and now they're just sitting on the shelf not making you cash, your working capital went down.
Yes.
Or I guess another way to say it, changes in working capital was negative
Yes.
on the inventory side.
Yep.
Yeah.
Yeah. Yep. I mean, it's it's a hard question. And
Yeah.
it's a hard
very hard
question to answer.
to
And when
answer.
you're a newer investor trying to visualize it, it can be very, very difficult. I know that Andrew and I have written about this on our blog, investingforbeginners.com. Go there and search for changes in net working capital or just working capital, and you'll be able to find lots of different explanations, some better than what we're doing today to help explain it. But I think once you wrap your head around it, it's a lot easier to understand. But I think using visualizations like Andrew was doing, I think is a really good way to try to help make it make sense.
Yeah, I didn't think the hot seat today would include changes in working capital, did you?
Right. Right. All right. Let's move on to something a little simpler.
Okay.
Maybe not simpler,
Down.
but easier. All right. So Brad asked a great question. He said, what do you make of high-level executives or board members selling large amounts of stock? He gives an example of a company that he owns, that he's been seeing a lot of the insiders, chairman, as well as the board of directors selling large amounts of stock. Everything looks like it's going okay. Is this something that gives you pause if you see this in an investment?
Yeah, I mean, for me, it really doesn't. I completely understand the thought process, and I think the intentions are good. I think it's great to try to find any little red flag that you can. But I just know how messy people are, and it's like you could need cash for any reason, and it could have nothing to do with how you feel. It could be a million things of why somebody needs to sell some stock. So yeah, that's why I try not to think about it that way.
I will notice it, but I won't really give it a whole lot of attention, unless it's the situation where maybe there's something going on that I need to understand why they're doing that. But I think by and large, to your point, we don't know if they're sending their kid to college or if they're buying a house for their mother, or maybe they're taking a trip and they want to use their money, or maybe they're doing renovations on their home or they're buying another home. I mean, these are all things that could be going on. If maybe a longtime board member is stepping down, you don't know if maybe they're unfortunately going through some health issues and they need money to help pay for those things, or they have other things that they need to do for their family. So there could be a gazillion reasons. The only red flag that really comes up for me is if a company is struggling mightily, like this company that he's explaining, everything looks really good from his viewpoint. But if the shoe is on the other foot, if the company is struggling mightily, and then you see insiders selling a lot of shares, that could be a red flag that maybe they're not in it for you. Like they're not in it for shareholders. They're just using the company as a way to monetize or grease the wheels of their own life, as opposed to doing what's best for shareholders. And you will see that more than you'd probably like to admit, especially for newer companies, younger companies, companies that maybe aren't as established, or maybe they're going through changes in management. And so you could see some more, I guess, short-term managers that come in and just try to fleece the company for as much as they can before they move on to the air quote next victim. So I think if you see something like that, then yeah, I would probably be concerned.
Yeah. I have nothing to add. That's all great stuff to keep in mind.
Yeah. Thank you, Charlie. I appreciate it. All right. Well, with that, we could go ahead and wrap up our show for today. I wanted to thank everybody for sending those fantastic questions and taking their time out of their day to ask us those questions. Again, if you have any questions that you'd like us to answer on the air, please don't hesitate to send them at newsletter@einvestingforbeginners.com, or you can send them to us on the socials, either X or LinkedIn, and we will get to them as we can. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.